Okay, good afternoon, ladies and gentlemen. Thank you so much for coming to this panel session on Enrich 2020. Today, in this session, we are going to talk about the MENA region and the transformation that is going to happen in this region. To do that, we've got a very eminent panel on this for the discussion. We've got with us Paddy Padmanabhan, who's the CEO of Aqua Power, one of the leading power developers in the region. He's going to share his thoughts. We've got Ms. Shama Al Rama, who's the Director Group Strategy for Enoch. And we've got Andrew Monroe, who's a partner with KPMG and the regional head of oil and gas. And we have Ralph Shipley, who's the director of West Hydrocarbons and is representative of a very important Emirati family in Abu Dhabi, who's in the oil and gas business. So we've got this very eminent panel. The way we're going to run it is I'm going to request each of the panelists to talk for 3 to 4 minutes, just a bit of the background, give their opening statement, and then we'll have question and answers, we'll debate, and open to question and answers from the audience as we proceed. And before I hand over to the panelists to introduce themselves, I just want to set the scene of what really are we going to be discussing. So if you have to really see the Middle East region, Lord Tennyson's words of the old order changes yielding place to new really apply here. And what do I mean by that? If you see in the last 20 years, the Middle East has been a very big oil player and also a gas player in certain countries. The next 20 years, however, is going to see a transformation. We're definitely going to have oil and gas, but we're also going to have a lot of play in what the Middle East is abundant in besides oil, and that is sun. And we're going to see a lot of transformation happening in the renewable space. It's already happening. Renewable prices have fallen, solar prices have fallen by 80% in the last decade. And the man who's driven those prices down is actually with us, Paddy Padmanabhan. He's going to share his thoughts with you. So we're going to go and see more of solar, but we're also going to see the sun used towards energy and transportation with the advent of hydrogen. And hopefully the hydrogen prices will also follow the solar prices, and then when it becomes economical, we'll have that as a very big play here. So the next decade, the next 20 years is going to be a coexistence of sun and oil in the region as compared to predominantly oil in the last 20 years. So we'll talk about that. And we'll talk about, what are the challenges? Will it really happen? Is it a reality? And before I give it over to the panel, I just want to say some very interesting words of Thomas Edison, who was the founder of GE, who said, "I hope the world realizes the power of solar before it runs out of oil." And frankly, that's happened. We've realized the power of solar, and the next 20 years, we're going to see that witness even more, and solar is going to be used even more than just besides power. So with that, I'd like to hand it over to the panelists to introduce themselves. So Paddy, can I request we start with you?
Thank you, sir. Thank you, Ravi. Thank you, my fellow panelists. Delighted to be joining you today. Paddy Padmanabhan, President and CEO of Aqua Power. We are a company headquartered in the Kingdom of Saudi Arabia, entirely focused at power generation and desalinated water production. We today operate in 14 countries, not only in the Middle East, but also in Asia and in Africa, Central Asia. Ravi's introduction is absolutely apt and very correct. So we are very much in the early stages of transition from what is extremely well known as the kind of petro-states, fossil fuel driven states in the Middle East, to an electro-state, all transitioning rapidly to embrace electricity. Several GCC countries are implementing very large renewable energy projects, both solar and wind, now at less than 2 cents per kilowatt hour cost, an unimaginable level of cost even just a few years ago. When the sun is shining during the day and the wind is blowing during not only the day but also well into the night, even the lowest cost producer of oil and gas cannot make available that fuel at a low enough price to generate electricity with oil or gas to to compete with the solar and wind for that energy we consume when the resources are available. Throughout the GCC, driven by economic growth and increasing need for social services for a young population, there remains a need for substantially increasing generating capacity to catch up with rapidly rising demand for electricity. As we head towards the end of 2020, with the economic activity severely curtailed by this pandemic, only one thing has changed. The cost of generating electricity by renewable energy has come down even further, now at levels of 1.5 to 1.7 cents per kilowatt hour. Cost of another human history using any fuel anywhere on Earth, and that we are able to generate renewable energy based electricity for 16 plus hours a day by combining wind and solar at GCC well below 2 cents. Production of renewable energy fueled hydrogen at scale using the electrolysis process starts to become viable. And the world is desperately waiting for this to not just use green hydrogen in transportation, but even more to fuel, in inverted commas, all the hard to abate sectors like fertilizer, chemical, and steel production as we try to reduce carbon emissions from industrial activity. While it may be challenging times for the GCC on many fronts, as it is for pretty much the rest of the world, GCC is well positioned to generate the much needed economic activity to recapture the agenda that has been hijacked by COVID-19 by continuing to spur investments in very large renewable energy capacity to serve its own needs and to produce green hydrogen for exports and to produce goods and services with this green hydrogen, further adding value to that green. So in simple terms, GCC is well placed to capture significant strands of the green economy and to continue to play the role as a reliable supplier to the world of not only low carbon fossil fuels, but now also renewable energy directly and via other energy vectors. Truly exciting times in this part of the world. Thank you, Ravi.
Yeah. Thank you, Paddy. Shama, may I request you to share a few of your thoughts and introduce yourself and what you do in more detail?
Sure. Thank you. Thanks, Mr. Ravi. My name is Shama Al Rahma. I'm heading the Strategic Planning and Portfolio Management Department at Emirates National Oil Company, ENOC. We're located in Dubai. However, we're catering services across different countries around the world. We have terminals in Singapore, Saudi Arabia, Djibouti, and Morocco. At the same time, we are into different parts, into like the aviation. We fuel the planes and we're fueling the cars. We have service stations in Dubai and the Northern Emirates. Soon we'll be in Abu Dhabi. At the same time, we are in the gas business and different types of actually oil and gas businesses. This is for ENOC Group. For me, I also for the future of energy in the Middle East. It's something that we are focusing on, especially for Dubai. Dubai has the Dubai Clean Energy Strategy for 2050. To fulfill that, there are many smaller, I would say, but the impact is very big initiatives that came part of this strategy adopted by ENOC Group, but at the same time adopted the government of Dubai level. Among these is the Sheikh Mohammed bin Rashid solar power, which is the largest in the Middle East. And we're hoping by 2050, 75% of the power will be from this actually solar project, which is one of the largest projects in the region or in the world as well. The other major project is Shams project. These two projects under DEWA, Dubai Electricity and Water Authority. Shams project is helping to transform from the traditional electricity to the solar panel, where it allows people to install solar panels and basically this saves the electricity bills. So these are a couple of the projects at that level. We at ENOC, we adopted a couple of these projects. Example of the service stations we're having. We have around more than 100 service stations. We install the solar panels on these service stations. This is one project. I will move a bit to the financial sector because I am a member of the Dubai Sustainable Group for the sustainable financial investment. It sits under the Dubai Financial Market and Dubai International Financial Center as well. And the aim of this group, which was established last year, is to encourage the investment in the sustainable energy to ensure the sustainability of the energy for the future. So these are a couple of things that we are in the region working on. And at the same time, I sit under the demand side committee under the Supreme Energy Council, and we have set of objectives that will fulfill Dubai agenda to a sustainable future for the energy. So this is about myself and the company along with Dubai, and I'm looking forward for a very nice discussion soon.
Okay, Shama, thank you for that. Very impressed by the work you are doing and your company is doing. And again, delighted for you to join our panel, especially on your national day, on your holiday, and that too from office. We are very grateful. Thank you for that. I'd like to hand over to Andrew to introduce himself in more detail and share his thoughts about the transformation in the region. So, Andrew, over to you.
Thank you, Ravi, and hello to everybody. Thanks for the invitation to this session today. Let me pick up on some of the points that were raised and perhaps give some alternative views in terms of generally energy in the Middle East. Obviously, energy in the Middle East, like any industry value chain, is dominated by the pandemic, and also the future is therefore largely dependent on the recovery that we expect to now be able to take place with widespread vaccination. I think that recovery will come in probably 3 large phases, dependent on the availability and affordability of vaccines across different regions. I expect to see a sharp return to oil-consuming volumes in 2021, albeit in waves in the back end of next year, the middle of next year. And we could spend a whole session just talking about the vaccine and why the recovery is going to take time. I don't think we expect the numerator of the oil price to change too much in 2021. It'll probably be around $40, something in that area, although there is volatility in the current OPEC talks at the moment. As you see, there is a little bit of a power struggle going on between the UAE and Saudi for the first time. ADNOC, as you're probably aware, has announced very large discoveries of crude oil recently, taking it up the strength order in terms of reserves, and ADNOC is on a rapid transformation journey, very impressive and rapid transformation journey. But it's true to say we're at an inflection point for crude oil consumption in the world. I don't think it's an inflection point that's going to be in the single-digit years. It's going to occur over 25, 30 years. Some value chains, I think, are going to be more rapid than others. Power generation, clearly. Automotive with gas-consuming cars, electric cars now coming to the fore. But what I want to just make a few opening remarks on is that what I think the Middle East's big opportunity for the next 3 to 5 years is around efficiency. If we don't expect the oil price numerator to transform dramatically back up to $80 or $100, then I think we face an efficiency opportunity here in the Middle East. I think it's a very exciting time for that. The lift cost of oil in this region is amongst the lowest on the planet. The Saudis are pulling oil and producing at about $8. The Emirati is only slightly above that. But I think what we also have here is, some business model efficiencies and obviously some socioeconomic demands on that price, which takes real oil price demand up to closer to $80 to $100. And that's something I think we're going to see the economies of this region work on as they diversify and more privatise. And I think we'll also see big efficiency gains in the majors like Aramco and ADNOC in transforming their business models. So it's exciting times, a lot to do, a lot to embark upon. And as both Paddy and Shama have commented, in the background, transformation of utilities, transformation of consumerism around different business models, which is good. It's good for the sector because it will create competition, it will create alternatives, and it was competition and high prices and inefficiency that created the boom in shale oil and gas in the United States. So I think alternative business models are good for the sector generally because they keep it on its toes and create that impetus to change. So for us at KPMG, very exciting times and massive opportunities in every aspect of this I head up for the whole of the Middle East, and that includes oil and gas, chemicals, mining, utilities, and renewables, which are vast sectors of the economies here. So I think great times ahead, next 5 to 10 years, and a strong recovery to start almost immediately December, January.
Great, Andrew. Thank you for those lovely thoughts and insightful views of the Middle East. Ralph, over to you for your thoughts.
Morning, Ravi. My name is Ray Shipley. I'm a merchant banker. I've been in the Gulf now off and on since 1986. I spent a lot of time financing infrastructure, buildings, hotels, shipping, aviation. I've seen the oil price when I did hotels in Cyprus in 1986 at about $15. In those days, we were looking at capital costs, which I'll come back to later, for putting solar on hotels in those days. Nobody said it was far too expensive capital costs, and the oil price would come down. Of course, we've seen oil price go from 15 to 140 back to 45. Today, I'm involved in various projects which involve, we mentioned Vietnam earlier, Paddy. I'm involved in a new gas-to-power project in Vietnam. I'm doing a very old-fashioned project, oil refinery in Kazakhstan, which again, we're deploying the latest technology. We have total recycled water. We are standalone power generator, and where we provide power back into the grid. Older technology, let's say dirtier technology, but essential technology to help substitute importation of crude products there. I'm also involved with some other companies today which are looking at a way to maximize power retention for things like shopping centres, using wind and solar as well. So I've come up with two headings, if you like, which I'd like to discuss later. One is called wealth retention, and one is called capital costs. These look at why we use alternative projects like solar and wind, and compare that over the period of the time I've been here to what the capital cost is, and where is the crossover. As Paddy said earlier, the power of solar has come right down, so I think there's a big crossover. But I see the Middle East as like a big sweet shop. If you have lots of oil to sell, and you would sell it at 140 before a barrel, you were happy. If it now comes down to 45 a barrel, you're actually a bit more conservative about, do you give that all away at $45 a barrel, or do you retain it? If you retain it, you have to become the most efficient place in the world, so you can't be consuming all the sweets, otherwise you have nothing to sell. But this is why I think the crossover between the wealth retention and capital costs comes to, which hopefully we can debate later, Ravi. So thank you.
Okay, thank you for that, Ralph. Very interesting insight. So let's have let's dive into a little more in the details of what has been said in these opening statements. So I think the first thought, maybe Paddy, you can give us your views on this. Many of the oil companies are now very active in renewable space, and actually some companies, their market capitalization on the renewable side is probably even equaling what it has been on the traditional business. And do you, as a developer, given that you've been so successful, do you realize competition for yourself? Do you see that this transformation accelerating? And do you think, the space of power developers is going to now be displaced to some extent by the oil companies who are getting into this business in a big way?
No, thank you. Look, that's a hotly debated subject right now. My view is very straightforward. The opportunity in front of us is massive. The need for transformation is there, but also the demand is there for phenomenal amount of renewable energy investments. So I really don't think you can have enough participants entering the market and getting the oil and gas companies involved. I think will be very useful, very valuable. They have very strong, big balance sheets that they can use to leverage, and they certainly do have a certain amount of capability and capacity in having deployed assets around the world in this and are continuing to operate. So, all the ingredients are there. Having said all, and so we welcome them, and we really do think And some of them have already done a fantastic job of sort of jumping in and transforming. I mean, Ørsted is a shining example of how it has completely flipped itself from a fossil fuel company to a renewable company. Total is not a bad example of one that is trying sort of guides. So everybody has got their strategy, and I think that's fine. They're welcome. The one thing that I do, though, I think they all recognize as they get into the renewable sector, the competency to get massive, complex infrastructure projects built in Shetland Islands in the Arctic is not exactly a transportable skill for rolling out fields and fields, acres and acres and acres of solar panels, which are basically putting frames on foundation and bolting them. And when you start running them, you don't actually need people. They kind of pretty much run themselves. Certain amount of cleaning is needed, but even that cleaning is now starting to get automated. So it's very different. They're used to managing projects differently. They're used to handling risks differently. And most challenging they're used to a level of return. So these are the things that they need to come to terms with, and their shareholders need to come to terms with as they transform themselves into what really is a much more stable, stodgy, boring business. This is not rocket science. There's a lot of technology, and the technology innovation is moving fast. Artificial intelligence is getting factored into all of this, but it is still pretty reliable, stable stuff. Solar power, rating them, grid, all the rest of it. So it's a different business. But I have no doubt you will have many of them really transform. It'll take a little bit of time.
Thank you for that, Paddy. So Andrew, you mentioned something very interesting in your opening statement about, the oil industry does well when there's competition and they've got to be on their toes. How do you see this panning out, this play between oil companies transforming into renewables, yet carrying on with their own business, and then, you have the conventional developers who've done a really good job? I mean, how do you see this panning out?
Well, I think it will be a continuous period of change. I mean, it's interesting that all of the different options for power or fuel or utilities they obviously have a cost and an environmental dimension to them, but there are other dimensions too, and the industry hasn't been immune to from an environmental angle, say on plastics, for instance. And you'll see when you go to a McDonald's restaurant, you don't get a plastic straw anymore, you get a paper one. But people in the plastics say they think the overall environmental impact on that is a concern. The durability of a plastic straw is so much better than the one of a paper, so the consumer then ends up consuming more paper with a longer term environmental impact. So I think environmental responsibility is clearly on the agenda. There's the full dimension of our environmental responsibility. If we shift quickly from traditional hydrocarbon fuels to renewables, we will have colossal amounts of obsolescence in the world, deep water rigs, refineries, and all of that sort of thing. So we have to do this in a responsible way. The durability is an important point. I think the consumer convenience is an important point around things. Yes, solar power is great, but it comes with an investment and a consumer convenience challenge. There's investment required and entry costs. So that's why I think we've got an inflection period, a transformation period of probably 20, 25 years, where certain aspects of this around solar power are, strong. The argument is strong for that. The reason, as Paddy said, is showered in sunshine for most of the year. But it will have to take place at a period when we don't create unnecessary obsolescence and we don't jar the consumer experience. So I think it's going to be an interesting journey, but it will have to take place at the speed at which the consumer will accept it across the long term. And I'll just give you a couple of examples here. There's been a fast transformation in the retail sector from high street mall shopping in the West to online, but it's created massive damage and you've seen just over the weekend, two massive UK retailers have gone into liquidation, Debenhams and the Arcadia Group, headed by Philip Green. You know, there's 25,000 jobs at risk there because of the value shift created from online. So we've got to take this thing, carefully. We've got to give the consumer exactly what they want, but I think it will be done in a way that has to take all of those dimensions into account. The reason I said it's good is this pressure places a change impetus upon oil super majors, right, who tend not to transform quickly, and that's just because they're huge companies. But I think the impetus to change they're aware of. Everybody is diversifying into renewables and hydrogen, etc. So, but I think it will take. It's a complicated journey, and it's different by value chain, as I said before. So, that's the main impetus we see for change.
No, that's very interesting, Andrew. Thank you for that. I think the challenge is that there's nobody really here to regulate the transformation. So while it's not nice to see what's happening, especially in the retail space, ultimately I think technology will drive it. So it'll be interesting as to, who can really regulate it to make the transformation painless. But it'll be interesting. So Shaba, can you share with us your thoughts and what's going on in your mind, in your company's mind? Enoch is a leading oil company in Dubai, and has been at the cutting edge of transformation. How are you all thinking about this? What's going on in your mind, and what are your thoughts for the next 15, 20 years in so far as Enoch is concerned?
Yes, thank you. Actually, the market is open for anyone to the business. Yeah. However, I would agree with Paddy and Andrew. It's not an easy journey for oil and gas company to shift directly. It's not at all really easy. Like as of for Enoch, I mentioned we're pure oil and gas organization. We recently finished the expansion of our refinery from 180,000 barrels per day to 210 barrels per day. With the current situation, imagine how things will be with the refinery. Again, we're expanding in our retail service stations. So the focus is still in expanding within the oil and gas to fulfill the requirements of our consumer. To shift directly to the other area of the renewables, I would agree, yes, it's good for oil and gas organization. You could see it in the other region, but not heavily in I would say in the UAE. In the UAE, we would see the focus will come from the mainly, like I will talk about Dubai. DEWA will be heading this, Dubai Electricity and Water Authority. In Abu Dhabi, maybe Mubadala will be heading this. So we will not see only oil and gas organization will go and invest in such investment. They will be participating, yes, but it will not be a core or a major strategic objective at this stage. Currently, we're trying to, I would say, let's milk the cow as much as we can till the coming 15 to 20 years. This does not mean we're not going to shift in the other sources of energy. This is one of the initiatives that we look for. We're starting gradually. The way we started with, as I mentioned earlier, having our service stations around the UAE. A couple of steps is to have the solar panels. Let's reuse the water within the sites. Having really green service stations. We're moving towards having really green service stations. So we're starting with those initiatives that will lead us to the bigger step. Then we will compete maybe with Paddy in the future. But I don't think the oil and gas companies within the region will be competing heavily at this stage.
Excellent. Shama, thank you for those wonderful insights. So, Ralph, you mentioned something very interesting. You said, the region has seen oil price at 140 and now it's in the region of 45. Andrew says it'll be 40. What do you see as the stress levels here? How do you see the region responding to oil prices at these levels? And how do you, for example, your own plans, you're very good in refining, you're putting up some phenomenally good refineries. How do you see that panning out, Ralph?
Well, I think if we stick with the Middle East, Ravi, we've obviously got a growing population. When we've done the statistics in Kazakhstan, for example, in fact, with your colleagues in KPMG, we looked at the growth in new car sales and the youth buying cars. So whatever we say about alternative energy, the demand at the moment for traditional motor cars and motor transportation is growing in emerging markets. So we're just going to fill a very small gap in a refinery gap between Kazakhstan's oil reserves and its refinery capacity. So if we then go back to your first question, say, well, what about the stresses? As our local economies here diversify away from oil economies, and let's say, as we're in the UAE, we look at tourism and manufacturing, instantly there's another demand for power that's not necessarily there in your local community. So back in the 80s in Cyprus, we had 700,000 people, we had 2 million tourists, and that was a 12-month season. So you could say the real population of Cyprus was 1.5 million people, half of which were very transient, but when they did arrive, their demands were very high. So in the hotel industry, for example, hot water, electricity, in this country, air conditioning, massive demands. So as you try to move away from an oil dependence and go into the other sectors, you automatically have a growth in power, and unfortunately, for the time being, that power is generated by crude oil. We've had a go here in the past, becoming more efficient in Dubai, and Paddy will remember this, when we went into district cooling. All of a sudden in Sheikh Zayed Road, the new thing was to build big square boxes, most of which I think are very inefficient, and deliver cold water to hotels, so again you could reduce their general power consumption on a daily basis. That was the first wave. I'm sitting in a new villa here in Dubai now, it's called a new green villa, and the ruling parties in Dubai have said we have to have solar. We've got a very efficient solar on the roof here. My power utility bill has gone from 15,000 in the summer months to 4. But then on the outside, I go and plug in my electric car, and then suddenly I'm actually using more power again. Where's that power being generated from? That's being generated from burning fossil fuels. And it comes back to my point before about wealth retention and capital costs. The average capital cost today of electric cars is very, very expensive. So people are not transiting to electric cars as we would hope to, maybe to hybrids, but not to pure electric. And if we all start to plug in our brand new electric cars in the garage, by the way, which I do not have one, again, up goes our power demand, and that goes back to ENOC providing us more petrol to burn to create the wealth retention. So there is a stress, because I think most economies in this part of the world need at least $60 to $65 a barrel to actually run their economies today, because they've got weaned off $25 a barrel. So that's where the stress is. The diversification of the economy is another stress. You mentioned retail earlier. Retail is going online, correct, but guess what? That's an Amazon transportation. There's a big lack of freighters in the world today. They're again burning more aviation gas to move these parcels across the world. So wherever we move, we're using the same amount of energy or growing in a different cycle. The only free one is the renewables. And until that capital cost comes down, I think it's going to be a great crossover between capital costs and power rates that we will see, which will de-stress economies.
Okay, Ralph, thank you for those insightful thoughts. Now, I'd like to change gears a little bit here and, open it up now to all the panel members. I'd like all of your thoughts on this. And if you read any newspaper or if you see any news, whether it's LinkedIn, virtually every country in the world has announced plans for hydrogen. Australia leading the charge, the UK has come out with a hydrogen policy, and many countries, even in the region, countries have announced their hydrogen foray. So I'd like to get a reality check from the panel as to, how real is hydrogen, how viable it is. And also linked to that, hydrogen, if it's going to be green, is linked with solar. And I sometimes really worry about solar because if we load on too much of solar onto the grid, we are causing grid instability. And I'm not sure whether at some point of time whether grid upgrades are going to keep pace with solar investments. and whether we are going to have a setback with these grid stripping if too much of solar comes on. So let's debate this theme. So Paddy, okay, if you can start with this, and then do we take others' views?
No, thank you. Yeah, look, that is an exciting subject. So why is there a sudden hype around hydrogen? Now, we all know very well from our physics lessons, chemistry lessons, sticking two electrodes into a pot of water, with electricity, you start basically breaking down the hydrogen-oxygen bond of water, and the hydrogen starts coming out. Now, so this is an age-old process. There is nothing, again, rocket science about it. The issue up to now has been the cost of electricity to do that. So, look, for all the people don't recognize this, for all the sort of numbers that get thrown about, if you were to average the cost of electricity in the world that we are blessed to have, don't forget that there are a couple of billion people who still don't kind of reliably get electricity every day. But if you take the rest of the world, all sorts of numbers is the average cost. But as an overall average, that number is in double digits. 11 cents, 12 cents per kilowatt hour. Today, in certain parts of the world where there is enough land, where there is fantastic solar and wind resources, credit conditions are reasonable, like UAE, like Saudi Arabia, like Morocco, there's many countries, Chile, several places, we are able to generate electricity at less than 2 cents. Now, everybody says, oh, that's only when the sun is shining and when the wind is blowing. Please recognize that in many of these places, the wind is also blowing at night. In fact, the wind is blowing harder at night. So we are able to link solar and wind in one separate sort of isolated grid and produce electricity at less than 2 cents for 16 to 18 hours a day. Electrolysis, very fortunately, is a process that you can actually switch on and switch off pretty much every day. So if you take those kind of energy cost and put it into an electrolyzer, you start to get hydrogen in a very cost competitive way. Now, okay, today we consume 75 million tons of hydrogen for fertilizers and all sorts of things. Okay, and that's produced by the steam methane reforming process by putting fossil fuel. Where the fossil fuel prices are today, we're able to generate that hydrogen at $1 a kilo. 1.5 depending on where you are. Okay, even at the kind of cost of energy that I'm now talking about for electricity at less than 2 cents, given where that hydrolyzer costs are, the capital cost of the electrolyzers, we are struggling to come down to $4, $3.50 a kilo. Okay, but this is very much in the early days. So far, nobody has paid any attention to mass producing these units. Not enough technology has gone in, not enough entrepreneurship and engineering on it. We see the industry sees a path for this to come down over a period of time as more and more projects get installed in scale to start to compete with the steam methane reforming process. Now that really will be transformative because that opens up all this hard to abate sectors. By the way, when you start to do hydrogen production at scale, you will not be connecting to the grid. You will have dedicated power plants, solar and wind plants that will be directly linked to that production. So that's not going to become an issue. But this is very much a reality. I think the material is out there in the public domain. We are very involved in what we expect to go to construction on, a very large hydrogen production facility in NEOM in Saudi Arabia in partnership with NEOM and Air Products, and that will produce 650 tons of hydrogen per day. And our objective is to convert that to liquid ammonia transportation and ship it for export. So, and we are right in the middle of it. We expect to go to construction early next year. So we really have an understanding of these numbers, and we are very confident of the future of green hydrogen.
Thank you. Any
Thank you.
other panelists, do you share Paddy's optimism? Andrew, what do you feel? You think hydrogen will be a reality or still a bit down the line?
I like Paddy's optimism. I think I've a lot of experience of the electrolysis process in the chemical industry, and I think we just have to bear in mind in this region that if we're going to electrolyse water, we start in this region with water already being a pretty precious commodity, currently mostly gained from desalination processes, which in themselves are pretty expensive. But look, it's true that hydrogen offers huge opportunities to our planet. But I think you've just got to put them alongside all of the other value chains. And the only thing I would say to temper the speed at which that will happen is I think the world now sits at the bottom of a very difficult economic cycle, of which it will, without question, climb out of over the next 3 years. And there's going to be a lot of mouths to feed during that period. I think the world invests best in boom periods. Sadly, not enough in boom periods, and has to then temper investment in recovery periods. So, I think that just in terms of the cell production electrolysis, there are massive investment projects. The world is steadily moving from mercury cell production across the membrane, which is environmentally safer and better. But they are big investment projects, and there's lots of investment. I think, just going back to my point around full environmental responsibility, where I come from in the UK it was a very short but profitable boom in the oil industry in the North Sea. The North Sea now carries with it probably something like $700 to $100 billion of decommissioning costs to cap off all of those production facilities. And the sad fact is there just isn't enough companies that remain that enjoyed that boom and paid their super taxes to the British government to conduct that. And I think we've got the same issue here in the industry. We have to proper environmentalism, proper protection of the planet means moving to the next thing whilst also making good on the previous legacy assets. And that's one of the things I think the world will have to get on and become successful in the future. So if we do jump onto solar and hydrogen, which I think we will, and I think we'll enjoy that, and I think we'll enjoy great economies of scale from it as well when it gathers momentum. But I think we also have to make sure that we make good on the historical legacy things. And what you find in any transformation program is that the great companies like Aqua who are breaking the ground on these big hydrogen facilities are new value chains. So the Apples and the Googles are the new value chains and not necessarily connected to the old value chains. And those value shifts happen quite quickly. And as you said, Ravi, it's either regulation or government's responsibility to make sure that we tidy up the past. So I think hydrogen offers a tremendous opportunity to the world. I think, as I say, it's one of those things that will happen over a 20 to 25 year cycle, and as Paddy says, it will happen more rapidly in some parts of the world than it will in others. But the numbers he's talking about, those differences in price for electricity are phenomenal for consumers and phenomenal for economies, right?
Great insights, Andrew. Thank you. So, Paddy, I think you were responsible and you led the charge, Aqua and other developers, Aqua leading, in driving down solar prices. And it's been a very successful decrease in prices. 80% reduction in solar prices in 10 years, 70% reduction in offshore wind. So can you share with us your thoughts on how do you see the hydrogen cost curve coming down? Because that's going to be critical. If hydrogen has got to be the new fuel and it's got to displace LNG, which has been a really good transition fuel, your cost curve has to come down. So any parallels you can draw from your solar experience to see hydrogen prices coming down, and what is the trend?
Lots of parallels, and in answering that, let me also just pick up a couple of things that Andrew pointed out. Okay, first of all, indeed, it's about splitting water, and we are in many of these places, Chile, the sort of tough part of Australia, the Middle East. These are all water stress regions. Funny enough, that's where the sun is shining the brightest and the wind is blowing the hardest. But so now we need the water. So what's the issue there? Well, please also don't forget, water is also desalinating water is an electricity intensive process, and that's what we use in our part a lot. But the costs of people haven't woken up to this reality. The cost of desalinating water has come down phenomenally. Just 5 years ago, energy priced correctly, not subsidized and not confused, desalinating water was over $2 per cubic meter. It's down to below 40 cents just in the last 5 years. We are now starting to introduce renewable energy into that desalination as well. That's the first part. Second part is, I absolutely right. These are all capex heavy, opex light. The good Lord doesn't charge us for the fuel, so fuel free. Okay, but there's a big capex, so massive investments are required. But you know what? I think we forget. There we were, just in a matter of 8 months. Yes, we were faced with a terrific, tragic crisis. Somehow, guess what? We managed to manufacture something close to $20 trillion. Happened. Okay, fine. Time will tell how we're going to figure that out. But so there is a huge amount of capital that is available, that is sitting, waiting, particularly in this negative interest rate environment, in order to deploy into essential services, asset-heavy investments. That's what we see. So we're not seeing, while massive capital is required, we are not seeing a shortage of capital out there. There's a amount of capital in bank accounts with corporates, high net worth individuals, sovereign wealth funds around the world. And that will get deployed because we know as we recover from this pandemic, we are going to have to deal with climate change. I think climate change, people are much more aware of it. I agree with Andrew, it needs to become inclusive. We need to carry the bits that we are leaving behind, the people we behind in the other industry as we go forward. But we're going to need the people anyway. We're going to need those skill sets, and we are seeing that transition as we go forward. So coming back to the kind of the path forward for things like hydrogen, and it's definitely my own view. There is no reason, as we are seeing inside the box, so to speak, why industry we cannot bring green hydrogen cost to competitive levels before 2030. Very, very, very possible. All it requires is another half a dozen similar scale NEOM projects, and you will see enormous amount of entrepreneurship and ingenuity thrown into it. The reductions will be exactly the same as we are seeing in photovoltaic energy and in concentrated solar power and in wind energy.
Thank you. So we're getting a lot of questions from the panelists, from the audience. I think there are a lot of interest in what has been said. But before I go to the questions, I'd just like to give Shama a few minutes to add anything more from her perspective, and then on to Ralph. Besides what we've discussed and besides what we've spoken, anything else which comes to your mind you'd like to share with everyone? Shama, over to you.
With regard to the hydrogen, currently we're
not only hydrogen, anything else.
Okay.
We've beaten hydrogen to death, but anything else you want to, anything we've not covered, anything you want to bring up which is on your mind besides what we've spoken about.
Yeah, I believe the esteemed panelists covered most of the areas related to the energy and the transition in the Middle East, and maybe the issue that was highlighted, some of the challenges, because honestly it's not an easy process to try to move towards this area. From the normal energy, the traditional, let's say, oil and gas, to renewables. I'm sure the people on this field itself will realize that. For us, for an oil and gas organization, this is what we would like to shift into. But however, it's not that easy. It's very difficult. Still, people are relying on the traditional energy, I would say. But we have to really plant the seed from today for the future.
Okay, Shama, thank you for that. And Ralph, anything you'd like to add besides what we've covered? Any insights? Anything you'd like to share with everyone?
Only that I think you have to be brave about capital costs. Yeah.
Okay.
What I mean by that, if I take you very quickly, Ravi, through the example of, which is very relevant for the market we sit in today, the hotels we did in Cyprus in '88. Okay? We put very efficient Australian hot water systems on the hotels. Okay? We powered them with LNG just for the winter months. We were getting away with $2 a day per room for whole hot water bill, which is enormous. So that wealth retention was kept by the owner. The amount of fuel that was burnt of imported oil in the Cyprus Electricity Authority was reduced only by one hotel. But the big argument, the companies like Andrew would have been arguing at the time, was, oh, isn't it very expensive? And I said, yes, but what's the oil price going to be like in 20 years' time, ladies and gentlemen? When I speak to those children who still own those hotels, which I do for their fathers, they say the best thing, Rafe, was you forcing us to pay the money up front for zero consumption cost of our hot water on our hotels. So that is the big challenge. And so we have to take off the discounted capital boys. We have to take away the bankers and say, if you stick it on top of a project and you put it as part of the mortgage, it's the same as the walls, the roofs, the bedding. We have to be brave. And I think Paddy's probably been one of the bravest of going through that challenge when he was doing large solar, when it was expensive. That's what we've got to do. It doesn't matter what it costs. If it's running on free, as Paddy said, the God's willing free, we've got to factor that in. If we can get the capital cost financing done, there's plenty of capital around to do that, that will just become a factor of what we do. But we cannot be run by economists who say it's too expensive.
Okay, Ralph, thank you for that. Okay, let's go to the questions which have come. I think many of the questions we've addressed, well, I think there are one or two. Now, there's one very pointed question which I would like to pose to Paddy because he gave the numbers, and I love posting pointed questions to Paddy. That's partly the thrill of my career working with him for the last 15 years. So, Paddy, the question is, one of the panel members indicated, well, Paddy, one of the panel members, which is you, which indicated cost of generation from renewable sources is lower than 2 cents per kilowatt hour, which is 33% lower than similar cost of generation in India. One of the key drivers for such low tariff is significantly low cost of capital compared to India. Now, what steps can India take from a policy regulatory perspective so that we can reduce the gap in cost of capital in India as compared to the GCC? Now, this is a very interesting question for you to answer because you've looked at India and you have, as Aquapa, stayed away from India. So we have a lot of people in India in this audience. So any thoughts, any insights you can give on this question would be well appreciated by the audience.
No, thank you for that. It's a question, and it is something that India is going to have to address as it sort of struggles to become more and more competitive, because energy is such an ingredient to everything and anything that we do that adds a cost to everything. So, I think the most important one is reducing red tape, reducing development cost time, because you see, okay, fine, everything else, the credit environment is what it is, let us say. So let us say that you're borrowing money at 10%, as opposed to somewhere else you're borrowing at 5%. The minute you then spend 24 months instead of 12 months doing something, you have you've not just doubled your cost of using that money, you have quadrupled it. So one of the best help India can do to itself, the government can help, people, policymakers, regulators, local politicians, cut the bureaucracy and allow the industry to deploy stuff faster. You will immediately shave off 30-40% of your cost, of your tariff, if you really factor that in. And the second one, is to rely more and more on domestic financing capacity and eliminate imported content. Because then it's easier for you to control the fund flow, and it's easier. Fine, your base rate cost is high in India, but at least your income and expenditure is matched, and you don't need to concern yourself with a lot of arbitrage there and contingency. But get rid of the rate. You'll save yourself a ton of money. That's the simplest answer.
Okay. Yes. Thank you. Thank you.
Toughest
Thank
to
you
do
for
it.
that, Paddy. Okay, that's a good, concise answer. Now, another question is on innovative financing. So, I'd like thoughts from Andrew and Ralph on this one. The question is that, a lot of green bonds have been used to finance these projects in the West. Do you see more of such innovative financing instruments coming up in the Middle East? Thoughts on that, Andrew? Thoughts on that, Ralph?
Well, I think Paddy made a great point, which was that there is a lot of, and one of the things the pandemic has created is a huge stockpile of cash. I think it just then becomes, the word innovative really just becomes an equitable return to an investor for that cash versus other available returns. As we know, interest rates in Europe and the United States are virtually zero. Taxation rates on investment, I think, are unbearably high, especially on renewables and innovative technology. So I think there's vast opportunities to create. There might just simply be, entrepreneurial businesses like Paddy's, setting it up, making a return, getting the investment in, and providing those investors with a return that beats other alternatives. The two big challenges are that stock market returns are still pretty good, even through the pandemic. The stock market has recovered and provided, apart from industries that have suffered like retail and aviation, has provided very, very strong returns through a pandemic. As Paddy said, productivity has remained strong for the planet, even in pandemic conditions. So the answer to your question is yes. There are lots of innovative mechanisms. I think the point on bureaucracy and government intervention is a big one, and is problematic and wasteful in a lot of these investments, and it's also extremely hard to change. But I think there will be continued companies that push through entrepreneurial models for finance to allow capital expenditure to flow. As Paddy said, one final point for me as well, I think, because the Middle East has never been shy of investing. I think the big companies in the Middle East have invested heavily. The challenge is the rate of change between 1.0 to 2.0 to 3.0 in all of these projects is becoming quite punishing. The UAE, as an example, invested very heavily in thermal desalination. As we've seen, that's moved on quite quickly. It's very hard for governments and these investors to just write that off and move to the next. And I think, unfortunately, Generation Y and Generation Z and the millennials and all these guys just expect corporations to write that stuff off and move to the next thing, and that's not possible, unfortunately. So they would be the sort of main comments from me.
Okay, thank you for that. Ralph, your thoughts. You're in the market. You're raising finance. You beat me up virtually every day for your financings. So your thoughts on green bonds, innovative financing in the region. What are you seeing? What are you picking up? You talk to a lot of banks.
Well, it's interesting, Ravi. I call it capital capture. For example, in the Middle East today, we have a lot of expatriates remitting money abroad. Very rarely have we had large institutions here, and somebody mentioned DEWA earlier today, large institutions issuing bonds which are properly pushed down into the retail market to capture those monies which are remitted abroad, often into tax environments. So I think if you're going to have a proper green bond market, those people, institutions where the names are trusted, and ENOC and ADNOC and DEWA and ADWIA, they have to be the first to issue those green bonds and not necessarily sell them down to the banks. They've got to have a proper market structure where those are distributed. And once those big companies issue green bonds, and everyone understands what that really means, And hopefully in some countries you'll actually get a tax credit for buying those, so the government have to step in and give you tax credits to be in the green business. Then you will see other issuers able to do more green bonds. In Australia, for example, if you put solar in your house and you then contribute back into the network, you actually get a massive tax break, A, to buy the equipment in the first place, and B, by contributing back into the system. So, of course, we don't have income tax here yet, but I do think that if people bought green bonds and their home governments gave them a tax break for helping them buy those green bonds, you would see massive growth. But everybody has to participate in the development of that. You just can't have a few issuers like Paddy doing that.
Okay, lovely. So we're coming up now to 5 minutes to the end of our session. So I'd like to use these 5 minutes for closing remarks from all the panel members, just to give their conclusion. So can I start with Shama, just giving your concluding statement for the session today and your thoughts?
First, I would like to thank you and the other members for this interactive session. Thank you so much. And I would like to stress that the future of the energy will change. Yeah, it might not be near now, I would say, or tomorrow. But as mentioned, with the new generation and with things changing, we could see the evidence that when the pandemic happened and started, lots of things changed. So we have to start the change process from now, not to wait later. Thank you so much.
Thank you for that. Thank you. Thank you for that. Andrew, any closing thoughts from you?
I think it's just what I said at the start. It's a very exciting period for the region, for this topic in energy and utilities. There's lots on the agenda, and it's difficult for consumers, for companies, and for investors to make the right choice. So I think we need to work together. I agree with Paddy's point around bureaucracy and governments delayering bureaucracy. I think it'd also be good to see a bit more global cooperation on some of these things. Wouldn't it be great to be able to just invest in an environmental bond and get a global credit wherever your money's sat or your income's sat? I think there could be a lot more global collaboration around some of the big items that affect the planet. So lots of opportunities and an exciting period, a very exciting period for the Middle East, I think, for the next 5 years.
Lovely. Thank you for that. Ralph, your closing thoughts on this?
I think I agree with other panel members. It's moving very fast. The capital markets have to change with it, and as I think Paddy said before, the regulation has to change very fast as well. Otherwise, we have a total disconnect. And as Andrew says, it has to be a global solution, not necessarily a regional one.
Excellent. Paddy, your thoughts, your closing thoughts, please.
I think many countries do this, but I think more late by creating that sort of environment to unleash human ingenuity and entrepreneurship, embracing all that technology is offering us to build back better, focusing on resource efficiency, sustainability, impact on climate, and it's got a nature-based solution to utilize delivery models that ensure as wide a level of inclusivity as possible is really what we should at. The objective not just to create economic growth, but to sort of ensure enduring sort of broad-based prosperity. And this energy transition gives us that opportunity. The nature of the technology offers that.
Okay, excellent. I think this has been a real discussion. I thank you all for coming today, sparing your time, taking the effort, sharing your thoughts of wisdom. A lot of experience here. As I said in my opening remark, the old order change. I think it's going to be very exciting. I've been here for the last 20 years. I've interacted a lot with you. I look forward to the next 20 years of working closely with all of you and the industry as the energy transition takes place and as we move towards, and at the same time, that global which is really real. It's very, very exciting. I think both, and also combat climate change. And as Andrew said, as long as we do this gradually and we don't have any sharp ups and downs, this transition will be exciting. It's not going to be as smooth as we expect, never is, but nonetheless, it's going to be very exciting. Thank you very much, all of you, for coming. Thank you for an excellent panel. I think we're exactly on the dot of the hour, and I think our session is over. Thank you.
Thank you.
Thank
Thank you.
you. Thank you.
Thank you.
Bye.